Hello and good morning, folks. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Shikhar Garg. Now, it was an illiquid market for us yesterday with the Columbus Day celebration in the US out there and the currency pairs having limited and muted moves. But there was some action by the central bank after the pair USD INR opened up with a gap on the higher side. Uh, as the outward transactions resume after long weekend break, JK, what do you think is in store for currency? All the while, the geopolitical tensions continue to simmer higher. We also heard yesterday, there was a lot of strikes happening across Ukraine by the Russians. So, geopolitics still continuing hot, macros, not so much of improving space, and central bank actions in line. JK, what do you think? What should we be expecting?
Yeah, good morning. Yes, being a US holiday, one would have expected it to be a calm market, but that was not to be because though there isn't much of an economic data, there were a lot of news flying around, particularly on the geopolitics. Russia attacked Ukraine civilians and knocking power and heat across cities in retaliation after an attack on the bridge linking Russia to annexed Crimea over the weekend. So the geopolitics were keeping investors very nervous. As if it was not enough, US government was intensifying its own economic war against China by imposing what is seen as the harshest ban on shipment of certain semiconductor chips made anywhere in the world with US equipment to China. And that is threatening to wreak havoc in the highly globalized supply chain of chips. The move is seen as a political politicization and weaponization of technology and is an attempt to slow Beijing's technological and military advances. Of course, this can hurt the US tech companies as well because they have large earnings from their exports to China and in turn will push the stock markets down further. So amid the ongoing tech tightening of financial conditions and inflation, S&P 500's year-on-year earnings estimate has now been downgraded to 4.1% for this quarter from 11.1 at the beginning of July. And four of the biggest US banks are expected to report earnings this Friday. Market waits nervously for their numbers. And US indices, obviously, only the stock markets being open yesterday closed lower. Dow now is clearly in bearish territory along with Nasdaq and S&P, and the all world index of equities was down more than 1%. Focus is again shifted to UK because there was a global sell-off led by UK gilts, notwithstanding a flurry of announcements designed to calm the UK debt markets. The US, with US out, yields were set to bounce sharply when US reopens today. And 10-year UK gilts closed up 23 basis points on the day to 4.47%. And the as widely anticipated by media, UK Chancellor is announcing that he would deliver a full set of economic and fiscal forecasts alongside the budget responsibility independent forecasts on 31st October. This is much earlier than what was expected, but that has not really calmed the markets. There has been some relief in oil prices that fell 2% as fears of economic storm clouds hovered, resulting in global recession. In fact, there has been a call by Jamie Dimon of JP Morgan for a deep recession globally in 6 to 9 months. There has been some news from Europe, even as their sentiment index dropped to the pandemic low, and it's not helped euro much, which is already struggling amid renewed geopolitical tensions in the Ukraine region. Europe is, of course, contemplating a joint debt issuance to tide over the difficulties that economies may face due to energy crisis. And this is the second time they are doing it, and the first one was done in post-pandemic, the issuance of which had actually pushed the euro USD higher as investors diversified from US bonds. But this time, whether it will succeed in the current environment of surging bond yields, something that needs to be seen. There is no let up in dollars rise against major currencies as the safe haven demand intensifies after the geopolitical developments over the weekend. and the Fed members continue to hop on need to keep rates higher. This week, we have the Fed minutes to be released tomorrow night at 11:30 p.m. IST. The crucial monthly CPI data will be released on Thursday. Economists expect a slight moderation in the year-on-year headline index, of course, as we have seen in the recent months. The forecasts are not so reliable of late. The only economic news from Europe, as I said, was bad. So euro has taken another tumble. Just 1.5% higher than its lowest level in the cycle, and GBP is holding just above the 1.10 psychological mark, even as we await the bond market reaction for the temporary bond purchase program that ends on 14th October. Markets are also preparing to test back of Japan as yen trades close to 145.90, where the central bank intervened last time. Since then, of course, US yields have moved higher, further higher, and so investors have no incentive to sell the dollars against yen unless, of course, we see a massive intervention from the Bank of Japan. Chinese yuan has also weakened towards 7.20 again, as the US-China tensions have intensified. And under its impact, we are actually seeing AUD hit a new cycle low at 620, which was again seen in March 2003. So we are actually seeing the currencies hitting the lows seen post-pandemic. Some of them have actually exceeded, like the euro and the GBP are drastically below those levels. So it's a new paradigm in the currency market. Only US dollar is favored as a safe haven, and very little attraction from other currencies as their respective economies face huge challenges. Rupee has, of course, seen no let up from weakness because we made a new historical high in the local interbank market, although presence of RBI throughout the day kept it below the opening levels, and their efforts were supplemented by US holiday, which meant trade-related outflows were not there. However, the rising oil prices, persistently high trade deficit, and narrowing of differential with the US dollar will keep rupees gains in check, even as RBI's reserves, as we all have been seeing, is dipping consistently. So technically, there is a medium-term projected target at 83 from, at least a sharp correction can follow from there. But as of now, global negatives are showing no relief for the rupee. A break of 83 can, of course, take towards the next round figure of 84. Even the central bank is possibly okay with such a move, according to some analysts. And if it is accompanied by a simultaneous rise in the dollar index, they may let it fall as well. So one should be prepared and be flexible as far as the US dollar INR target is concerned. That's it. Of course, let me end with the information that Ben Bernanke, the architect of modern monetary theory, money printing for markets, has been awarded the Nobel Prize for Economics. Thank you.
Okay, wonderful, JK. That was quite interesting. And yes, folks, I'd like to just highlight the bit wherein JK mentioned that one has to be flexible when it comes to the expectations of USD INR. There are good likelihood of the pressure continuing on the macro side, which can eventually lead to a higher USD INR levels visible. But there is also good intervention by the central bank visible. Plus, all in all, there's a paradigm shift in currencies that we are seeing. All of the currencies having new lows visible, albeit only and only USD, the dollar, which is having a safe haven rally constantly going on. But on the other hand, there's one more bit that I'd like to highlight is the harshest ban by US on the semiconductor trade by with the China. So this, folks, yes, is interesting development on the trade front, and the geopolitics continue to stay hot, even though there is a lot of discussions on the inflation front as well going on. So it needs to be seen that the financial markets are being gunned down by not just the macros but also the geopolitics. So investors as well as the market participants, be cautious and let's see how things turn out in the coming days. That's it for today, folks. We'll come back again tomorrow with another round of updates. Thank you so much for listening.